Good afternoon or morning, everybody, depending on which coast you're on. My name is Randy Jones. I'm the head of originations here at ApplePie Capital. I have on the line with me Ron Feldman, who is the Chief Development Officer at ApplePie Capital as well. Today, we are going to be going through 2019 growth planning for franchisees. The year is coming to an end. It's a good time to start planning for your future growth. So today's topic should inform you all of different things that you need to do to start to prepare. Today's attendees on the call represent close to 30 different brands. 50% of you are either just getting started into franchising or have one unit open. The remaining people have the remaining 50% are multi-unit franchisees. Just as a housekeeping item here, you'll notice that in the bottom left-hand window of the webinar, there is a chat feature. Please, we encourage you to enter your questions in that as we present. We'll try to address them as they pop up. And then certainly at the end, if remaining questions come on, or go ahead and, if remaining questions pop up, go ahead and ask the questions at the end of the webinar as well. So from here, I'll pass it over to Ron, and he'll go over the topics that we're going to cover.
Thanks, Randy, and good morning or afternoon to everyone. First thing is that we really want to talk about is how to determine if you're ready to grow in 2019 in terms of self-reflection and your capacity, what requirements you have. Recent rate hikes, we should have put an S on that, and they're not finished yet. What the impact of that could be on you and your operation. What are the first steps that you need to follow in creating an actual strategy instead of being transactional in your thinking? Fifth one is really important, and that is about your financial presentation and what you can do in Q4 to prepare to access the capital markets next year, and how the best way is to leverage our team, our expertise, and our network to help you facilitate your growth.
So how do you determine if you're ready to grow? Some of this is relatively logical. However, you do need to assess, ultimately, is your business viable? Do you have regular customers? Meaning, is there cash flow coming in? How are your trends? And do you have consistent margins? What I would say is, with respect to consistent margins and trends, is that ultimately lenders will look to see if you're a newer franchisee, have you stabilized and are able to operate the units efficiently. That's really how those two tie together. It could be sales trends, but also EBITDA trends, and the margins being consistent is really important. Also, from an operational standpoint, meaning your ability to operate the unit, are you comfortable with adding additional units, and have you figured out how to run whatever franchise concept you're looking at or a part of? If you've figured out how to run those efficiently, is there demand in the market, or you have too much business? Believe it or not, having too much business many times starts to deteriorate some of your customer service, et cetera. So that might be a good reason to expand as well.
I just got a comment that we might be having some audio issues. I think we're trying to resolve them. If you could let us know if they're resolved, that's great. Some of the questions that you should ask yourself, what is your financial capacity for the next 1 to 3 years? Does your growth plan align with your financial capacity, or do you need to perhaps get a partner or figure out what you need to do to get there? More importantly, what is your operational capacity? Because if you can't execute, doesn't matter how much money you have. Is there territory in your current brand that's conducive with your growth plans, or is your territory sold out in your current footprint? Should you consider looking at other brands so that you can maximize your infrastructure within your current territory? How do you benchmark against franchisees in your system? Are your sales comparable with the market? Are they Is your EBITDA comparable with the market? Is your cost of goods sold comparable with the market? Are you above average, or are you average or below average? And lastly, you should go into every decision with, what is your exit strategy? What is your succession strategy? Do you want to be in this business till you retire? Well, that's a good strategy. You want to be in this business until you turn 60, that's a great strategy. But you need to know, we can always change it, but it's always good to have a plan and follow that plan until you want to change it, and then you can always adjust thereafter.
So as you go through this growth planning kind of thought process, the other questions that you should ask yourself are the what if questions, which are a little bit different than the questions that Ron just went over. We are seeing a significant opportunity in acquisitions out there. Typically with acquisitions, many times there's multiple stores available, and so what if you were able to buy multiple units and double in size? How does that impact your current operations? What if you're looking to go into a different brand to diversify, and if you're going from quick service restaurant into fitness, does your operational team have the ability to manage something completely different in operations? And then ultimately, if you build 2 units that open within weeks of each other, this has happened many times, and for smaller franchisees, many times this becomes a distraction from your current operations. For larger franchisees, they may have infrastructure in place. So the point is what are you going to do if this happens? And we are aware that you don't have complete control of the real estate market, and when a location pops, and it might be multiple locations, you want to take advantage of that. You need to assess what if that does happen. Ultimately, there's a potential. We are seeing some activity for distressed units that are for sale, meaning their profitability isn't as high as what the previous owner would like. People are taking advantage of buying those at a discount. But what happens to your current cash flow if you're absorbing a unit that doesn't perform as well, and do you have enough capacity to ramp that up? The other opportunity that's out there is the opportunity to buy multiple locations, and they are well performing, and those are trading for higher dollar amounts than a new store development. And so what happens if that opportunity presents itself? How do you set yourself up to be able to take advantage of some of those opportunities? And so overall, really what you just want to analyze is how do these decisions impact your current operations, but also financial capacity?
Absolutely. You don't want to risk what you have just for the sake of growth. You don't want to grow for growth's sake. One of the strategies is to add units one at a time and grow organically. The big benefit to that is that you pick your locations and you control the staffing from day one, and you control the build out. The downside is that's not scalable, and it will distract you from operating your business. Building units and developing units is very different than operating units. So it's a different skill set. If you are a one-person operator, that may distract you from your existing operations and harm your existing business. You want to make sure that you have the capacity to do that. There's more financing challenges also in growing organically, especially as we see some of the sectors right now that are growing quickly, like personal services and membership-based models versus straight QSR, where you open up at a high sales volume versus a lower sales volume. You need to make sure you have enough working capital and enough dry powder to make sure that you can open organically, get to profitability, and then open your next unit, or have deep enough pockets that you can open multiple units and burn that cash while you're building things up to break even and better. So you really want to, again, this is all part of self-assessment and making sure that you understand and doing your own sanity check on your growth plan.
So what are the requirements needed to add additional units? And these are lender requirements. Here at ApplePie Capital, we have several different lending options. And so this is kind of just a broad range of what's available out there for you as operators. And if you're looking to grow, here's some of the debt options and what lenders look for. So number one, equity into the project. Notice I didn't say cash into the project. For people that have existing operations, there is a possibility of using the equity that you have built within your business to help contribute to future growth. So it doesn't necessarily have to be cash. If you're a first-time franchisee or a single owner franchisee that hasn't been in business for very long, then it typically is cash. But with SBA financing, you can typically count on 10% equity, again, either contributed from cash or current operations. SBA is trickier to use current operations, but there are a couple lenders that are out there that do it. With conventional financing, typically want to focus on 20% down payment, again, either from cash or embedded equity within your business. Now, the next piece is liquid cash reserves. Banks do want to see that you do have some personal cash left over or business cash left over for the rainy day fund. Typical rule of thumb would be 3 to 6 months of fixed expenses. So if you have $6,000 of fixed expenses a month, then want to see anywhere between $18,000 to $50,000. As you can imagine, the larger the fixed expense, that number goes up a little bit. The current locations should be meeting their debt service coverage by 1.25 times. So really what that means is if you have $100,000 in loan payments, then you have to be bringing in $125,000 of net profit to cover that. That does include, you are able to add back your standard depreciation, amortization, and interest, et cetera, to get to that number. But they do want to see that you're bringing in more money than what's going out before they'll lend again. Now, depending on various lending options, some traditional bank lenders want to see that over seasoned tax return. Our product, our ApplePie Capital Core product that we will use 6-month annualized statements in order to assess that. But in either scenario, do want to see that you're bringing in more money than what's going out. Now, with that said, there's two types of products or differentiators there. If the existing cash flow doesn't cover the additional debt, then you'll be forced to use projection-based lending, which is typically SBA or our ApplePie Capital product. If the existing cash flow does cover the new debt, then you might be eligible for traditional bank financing through lenders that specialize in franchise lending. And the only reason why that says might is, as I mentioned here earlier, we have people representing 30 different brands on this call, and where the differentiating factor many times becomes a brand review process. So I don't want to mislead everybody that says at this point in time you will be eligible for traditional bank financing. Debt to EBITDA is a ratio of 4 to 1. So in other words, if you have $400,000 in debt, then your EBITDA or cash flow needs to be $100,000. And why I mention that in this call is more and more lenders are starting to look at this figure. It's actually triggered by some of the Fed review since the financial crisis. So I did want to point that out. In other words, they don't want you, even though your cash flow might be able to make the monthly payments at a 1.25 times ratio, they are also assessing what's your total debt structure. And then global debt service coverage is just a reminder that lenders will also look at your personal income and your personal debt combined with the business. So if you're an owner-operator that is paying yourself a big salary out of it, they will look at it globally and to assess how it looks on a global basis.
And we have a question on why is SBA trickier with adding an additional unit. I think the point Randy was making is using the equity in your existing business to grow instead of using cash as your equity injection is trickier with SBA, and that's something that we would have to deal with on a case-by-case basis. So I would suggest that you reach out with that question individually. But that's the issue. It's trickier in using your embedded equity. When we look at starting up 0 to 1, that's roughly, I guess, 30 or 40% of the people on this call. Many of you are, corporate folks who've never owned a business before and who are trying to get into business for the first time by, and in franchising, you're in business for yourself, but not by yourself. Some of the pitfalls that we see are the fact that you've never applied for financing in a business way. It's a completely different package. It's not a mortgage and it's not a car loan. You need a business plan. You need projections. It's a completely different look in terms of creating the package. Using up too much of your cash on unit 1 can handcuff you when you want to open unit 2 and 3. You want to make sure that you are looking at what your goals are and planning your liquidity accordingly. Looking at the FDD in item 7 for all the costs, those are averages. That's not what your costs might be. If you're building in a big metro area, that's not going to be average. It's going to be higher than average. The working capital is usually just 3 months of working capital in just about every FDD. That's not going to work with business. So you need to really understand all of that. And then figuring out what your path is. You got to look at your ultimate goal in terms of how many units you want to open and figure out how far your internal resources can take you and have a plan to get there. So the big takeaway is to preserve your liquidity as you possibly can, take the longest loan terms that you can, and make sure that you have enough working capital to get to profitability based on the brand that you're involved in and the market that you're involved in.
So how do you finance your first franchise or potentially you're going from 1 to 2? So these are relatively obvious points here, but cash, you could finance the business with cash or business partners with cash. As Ron mentioned previously, that it's safer to preserve your liquidity. Many times the easiest location to borrow for is the first location because it's all projection-based lending. And we see a lot of people make the mistake of utilizing most of their cash to finance unit 1, thinking it'd make it easier to borrow for unit 2. It's actually the opposite. So preserving your cash is definitely a possibility, but I say tread with caution on that. Security-backed line of credit is utilizing your stock accounts, typically at a lower interest rate, and it's a true line of credit. The challenge with that is there's typically some type of margin put on it. So in other words, if you need to access $500,000, it may take $750,000 to $1 million of funds to fund that amount because they will discount it. SBA loans are probably the most common tool for franchisees looking to start their first unit. It's a very effective program. It allows for all the working capital that Ron referenced and will finance anywhere between 80 to 90% of all project costs, including franchise fee, et cetera. There's 401k rollovers that you could utilize. There's companies that specialize in setting those up to make sure they're done properly to adhere to IRS guidelines. So if you are going to utilize retirement accounts to help fund your business, we've used that strategy in certain instances. But you do want to make sure it's set up so that way you're protected from the IRS rules. Other avenues could mean a combination of any one of these. We also have our direct ApplePie Capital loan product is available to franchisees, startup franchisees of certain brands.
And I see another question came in about the new laws requiring rent to be written as debt. That's still an open issue. We're not accountants. We don't play them on TV. But what will happen ultimately, in my opinion, is if that becomes the rule, then all the ratios will just get moved, or they're going to treat it as something separately. They're looking for sound cash flow lending. So I think the ratios will change if the laws change. I wouldn't give it a big concern at this point, but again, I am certainly not an accountant. So make sure you have good professionals who understand those rules, and that's a cutting edge rule. So you're really on the sharp edge of the knife. Moving on to, once you've got a couple of units open and you want to grow to 5, the biggest challenge we see is people running out of cash. So the key here is, if you did the right job on the first couple of units, you preserve some of your liquidity so that you can open more units. Some of the things that happen when you don't do that is people take on these risky financing vehicles like the merchant cash advances, or some of these online lenders that will lend you against your credit card receivables, against your daily deposits. Those loans are all very short-term, high-interest loans that will handcuff you from a cash flow standpoint. So you want to not do that at all. One of the things that we see quite often is people always gravitate towards the cheapest capital. And if you're in growth mode, the cheapest capital isn't usually the smartest capital, because you need to have the most flexible capital to get you to the point of being mature, and then you graduate to the cheapest capital. And that's one of the things we really try hard to educate franchisees on. While you're in growth mode, the interest rate is far less important than the amortization schedule and your monthly payment. And once you get to your mature phase, then you just refinance out, and you then take on the lower interest burden. The other thing is, you're not going to grow profitably if you're unprofitable. You're not going to buy your way into profitability. You're not going to grow your way into profitability. You want to make sure that your existing operations are really buttoned up and well funded and profitable before you grow. So the big takeaway here is, preserve your cash. Cash is king, and grow at the right pace, not for growth's sake.
So what are the financing options to franchisees, emerging franchisees with 2 to 5 units? SBA is still a viable product here. You just have to be careful on certain SBA requirements, such as pledging personal assets as collateral, and if you pledge those assets, how does it potentially impact adding more units in the future? It may or may not impact that. Just pointing it out, that is a requirement of the SBA to take personal assets as collateral if they're available. And if they're not available, it doesn't mean you're excluded from an SBA loan. It just means that you just have to assess what happens if, again, circling back to that question. ApplePie Capital, our core loan is we're designed for speed and efficiency with respect to, we have a little, our underwriting criteria, again, is based on 6 months, most recent 6 months cash flow, as opposed to having to rely on a full set of tax returns, so we can jump into the game a little earlier. We also don't require personal assets to be pledged as collateral. Conventional lenders, just for specification here, clarification here, this is banks that specialize in franchise finance. For smaller franchisees, it's generally not available for most franchise concepts. There are some select franchise concepts that it is available for. That's not a knock on the brands where it's not. It's just ultimately they're larger franchise concepts with more data, and so therefore banks, traditional, conventional franchise lenders will step in a little bit earlier. So that depends on the brand that you're in if you qualify for that. Excuse me.
Once you've got 5 units, you're a little more into the driver's seat. And what we see here is, again, people leaving cash on the table. This is where you want to use the equity you've built up in your business because you've already probably paid off a bunch of your principal, and you want to lever that equity to grow from 5 to 10 units if that's what your plan is. If you're going with conventional lenders many times exclude small and soft costs from financing. And you want to make sure that you're not using up too much of your cash and getting these deals done, because if you still want to grow, you want to use other people's money to the best that you can. The other thing that happens when you're dealing with conventional lenders is you have loan covenants coming into play, which don't really exist in SBA as a rule. And some of these loan covenants can actually dictate to you how much money you can make. So there's a thing called a post-distribution loan covenant, and you want to be careful about those. You want to understand exactly what those loan covenants mean, because if you trip a covenant, it's going to cost you. It's going to cost you a covenant waiver fee, and that is not generally a good thing. Biggest takeaway here, again, understand your growth potential. You don't need to use your cash out of pocket if you've got equity, and make sure you understand the implications of going to lower cost financing.
So funding options for mature franchisees, again, 5+ units or more. Conventional lending, it starts to be more common in this type of franchisee range. The benefit to conventional financing is they typically will offer the lowest rate, but it also comes at an expense of the lowest amount of flexibility. Ron already touched on the loan covenants, et cetera. You just have to be careful to read your loan documents when you jump into conventional financing. We've done a significant number of projects helping franchisees get into conventional financing. So there's nothing wrong with it. You just have to understand what the loan documents say. That's probably the biggest takeaway. And you should have an advisor or somebody helping you understand what they say, so that way you have systems in place to help track whether you're coming up against a covenant, et cetera. Our ApplePie Capital Core product is a very good product for people that are looking to grow quickly. Again, without personal collateral being taken, and the financial, we will take a look, again, hate to go back to this, but 6 months financial statements as opposed to tax returns, where this is really helpful for larger franchisees, and specifically somebody that's added 5 units over 3 years. That's pretty aggressive growth for conventional lending, and it's where we play well in that category. SBA financing typically is less attractive at this point. You've kind of graduated above that. The one good use that I see SBA for is for real estate transactions or potentially larger acquisitions, and because the SBA financing offers on real estate transactions 10% down, 25-year amortization, so it's less money out of pocket. Longer amortizations yields, to Ron's point, a lower monthly payment. With acquisitions, it's potentially a viable project or option because they will go as low as a minimum of 5% cash from the buyer, assuming the seller is willing to carry 5%. They will lend up to 90% of the acquisition. So we have successfully utilized that utilized SBA for some acquisitions as well.
Some of the pros and cons of the options that we've discussed. If you're looking for speed, SBA is probably not the way you want to go. If you're looking to not pledge personal collateral, which is your home, your investment properties, your stocks and bonds, again, SBA is not the way you want to go. If you're doing a first unit, you're not really going to qualify for conventional financing unless, of course, you put up 100% or so of the cash collateral, when you might as well use your own money at that point. If you're doing projection-based financing, you're really locked in again to either SBA or our ApplePie Core product. If you're looking to get multi-unit commitments up front, SBA, again, it's a limitation of what SBA generally will do. If you want to have no loan covenants, though, SBA is a very good option. Most other loans come with some type of loan covenant. And if you're in a very young brand, Unit 1, Unit 2, Unit 10, where banks aren't familiar with it, or if you're opening Unit 1 in a brand new market for a smaller brand, generally the bank wants to have that SBA guarantee as a fallback position as opposed to taking all the risk up front. So those are just some side-by-side comparisons of what the pros and cons are of each of the products that we're discussing on this call.
So as you all are aware of, and whether you have a credit card, most home equity lines of credit, or a variable rate business loan, you're aware that the Fed has raised interest rates. And it's definitely having an impact on you at this point in time, whether it's a personal loan that's tied to prime, your monthly payments going up. Similarly, for a business loan that's tied to prime, that's a variable product, your monthly payment is going up. I can remember back in 2006 and 7, when prime was around 8 to 8 3/4, SBA loans were being written at close to 10%. And nowadays, people, if I told you you'd have a 10% loan, you'd probably have a heart attack. And so the point is that rates are trending up. Historically, we're still at lower historical interest rates comparatively. And so reality is they'll continue to trend up. If you're in a variable rate product right now on a business loan, just to clarify that, if you're in a variable rate business loan, it's probably a good idea to fix that so that way you have a better understanding of what your monthly payment is going to be on an ongoing basis. Some added benefits to it would be as if you are in an SBA loan that has taken personal collateral to help secure the loan, then by refinancing into either a core loan, our ApplePie capital loan, or a conventional loan, that personal collateral would then be released back to you without a lien on it. The other benefit to it is we had a borrower that had 15 different loans from 15 different lenders, and at that point in time we decided it was a good idea to kind of clean everything up, consolidate into one monthly payment just for simplicity's sake. So not only is it payment protection or release of personal collateral, also another reason to look at refinancing would just be to simplify your life.
We just see another question on a first unit. What can we expect today as total interest rate with SBA through ApplePie? We use our lending network. We are not direct SBA lenders. But you can start with a floor of about 6.3% if you qualify for the fixed rate. And the maximum right now with prime at 5 1/4, so the maximum is 8%. So it's going to be somewhere in that range. For the brands for whom we do business with as partners, generally we can get those fixed rates at the lower amounts for first-time borrowers. Again, it's all based. It's very much based on the strength of both the brand and the borrower. I hope that answers your question. What are your steps in creating a financial strategy? How do you want to do that? First thing you need to do is define your goal. What is your ideal outcome? How many units do you want to have open and how much time? Then you want to look at your financial statements and take an assessment of where you are. You want to strategize with a professional, not just your CPA and your attorney. I can tell you that most CPAs are really good at tax, and many of them are not so good at business. You want to speak with a professional who understands this. That's something that we pride ourselves at ApplePie at being very, very proficient at. You want to look at what the cash flow is, not just of your business, but also of your life. If you've got a vacation home and 3 cars and you need to maintain that lifestyle, is the franchise that you're getting into going to provide enough income for you to do that, or is it going to take some time, and do you have enough capital to get you to that break-even point? And then you want to implement your strategy, of course. And lastly, after you did do the transaction, you want to take a real sanity check and see, did it end up the way that I thought it would? One of the jokes I always tell is every projection that's ever written is wrong. They're either high or they're low. I've never seen anyone ever hit a projection to the dollar. So take a look and see how you did, whether you exceeded your projection or you didn't, and adjust accordingly as you go on your growth path.
And to that last bullet point that Ron just referenced there, many times when you're adding your second location, many times lenders will request your projections that you did for your first location to assess how you're comparing your actual operations compared to your previous projections. So not only is it important for you to make sure you're keeping track of it, but many times lenders will also ask for that just to compare how you felt you would do to what reality is. So this ties to Ron's bullet point on the previous slide. Set your goal. Put it in here twice on purpose. Set your goal. Know what you're looking for. Know what you want to do, and to take care of your personal living expenses, build wealth, and satisfy your partners, but also anything else that's in there. You need to really understand why you're getting into this and why you're growing, and the goal is the most important thing. And I would state this, if you don't set a goal of weekly or monthly revenue targets, then it's going to be pretty hard to get to where you're happy. So set that goal, adhere to that goal, and make sure you're checking against it on a weekly basis.
There's various ways to hit your goals, and debt is one that has pluses and minuses. So we like to be very transparent and understand what are the pluses and the minuses. So leveraging your business plan on performing new unit growth is great because you're borrowing the money before you have the revenue. But you are going to, at the same time, lower your personal assets to facilitate the growth by virtue of the down payment. Or if you're using your own money, you're going to really lower your own assets because the assets in your unit as assets, in other words, the chairs in a haircutting place are not worth what the business is worth when it's running. The big positive here is you own 100% of your business. And ultimately, that can become a big cash cow for you versus having a partner where your partner doesn't go away until you buy them out. So it's a really expensive way to grow, is to bring in partners. The big downside here is you're all in. You're risking everything you've got to keep getting more. And you've got to be very confident and know that you're going to be able to execute on your business plan in order to make sure that everybody gets paid, because when you don't pay a bank back, it's never a pleasant experience working it out.
So another form of growing is through equity. Private equity is getting more and more common in today's world. The challenge with this is it's more expensive in the long run. Bringing in somebody else's money outside of bank debt that you're personally guaranteeing for typically comes at a larger expense. So there's two ways that equity works. One is a combination of two things, actually. One is they may want some type of annual return, but then also at the end, when the company's sold, they want a bigger return. Some equity partners may be just looking for a return at the end. So the challenge with equity is you're not getting as much of the benefit out of your hard work. Equity investors typically don't want to operate. They rely on you as the franchisee to be the expert in operations, and by them contributing the cash to fund future growth, they want a return on that cash that's typically larger than what your loan payments would be if you just funded with debt. The advantage to it is most equity partners have larger or have deeper pockets and you can grow quicker. But again, the disadvantage is the succession plan down the road. They're going to get a much larger piece of the pie when the entity sells and potentially also during the operations.
The simple math here is owning 100% of a smaller thing worth more than owning 65% of a bigger thing. And that's kind of the sanity check that you need to do on raising equity. And then there's a hybrid where you can use a little of both. And that's where you'd maybe take in a smaller tranche of equity and a bigger piece of debt. The downside here, and I'm not, because other than that, it's the same as what we've discussed, but your equity partners might also have to guarantee the debt personally alongside you, and that might be a game stopper for them. So you want to make sure that everyone's on the same page and that you understand what the business's goals are, what the limitations are of the growth, and that everybody's willing to put skin in the game at the level that they need to execute on the growth plan.
Yeah, and if you're looking at a hybrid strategy by bringing an equity investor in, and many times in this hybrid strategy, many times we see this being friends and family or potential franchisees near you, and so what I would always recommend is make sure you have an attorney structure the agreement, and to Ron's point, just make sure as you're starting the discussions, understand what everybody's willing to do, meaning personal guarantee, how much cash you're going to put in, and what the ownership percentage is, and then have an attorney review it so it doesn't hurt friendships and family and lifelong relationships with people. So acquisitions, as I referenced when we first started, acquisitions are a good strategy. We're seeing a lot of activity in the acquisitions right now. Some strategies to fund these usually would be to see if you can utilize some of your embedded equity. If you're purchasing a well-performing franchise, many times those multiples are 3 to 6%, or 3 to 6 times cash flow, which means it's a pretty sizable project. A lot of people don't have the liquid cash to put down for the down payment, so this is when it's a good idea to tap into the equity that you've built into your current operations and apply them. Also, combining financing options. We went through the various options there. As a strategy, it might be a good idea to combine an ApplePie Capital core loan with an SBA loan, or an ApplePie Capital core loan with a conventional loan, or conventional with SBA. So there's nothing wrong with combining different loan products as long as it's a well thought out strategy. When assessing an acquisition, many times the seller's financial statements are different than yours, and so you want to make sure that you have the ability to kind of run through those. And so make sure you're consulting with somebody that's separate from the seller's representation to assess what the financial statements look like and what multiples multiples of cash flow are acceptable for a given brand. Every brand has different ranges of what a transaction or an acquisition would go for. So somebody that understands your brand, but also meaning the multiples of the brand, but also the financials of the brand is crucial.
When you're in business and you're operating, you're also going to have to deal with remodels and re-images. And you want to make sure that you don't kick that can down the road and that you're prepared. There's a lot of financial strategies that you can use to fund those things. Some are you can use your cash. Some are generally when brands do these programs, they have a partner. We've just executed on a couple of them with brands for POS systems, for remodels. We're embarking on a very large one next year that's pretty substantive for a 1,000-unit sandwich chain. So you want to make sure that you have the right financing in place to execute on those remodels and re-images. It might make sense for you to do them in a one-off basis, unit by unit, and it might make sense for you to do a global refinance and cover the cost of doing all of them. Again, you want to get perspective from somebody who understands what it is and can help you walk through it. One of the things that we see a lot of franchisees not account for is to have additional working capital if that reimage is major and you have to close the store or just have the drive-through open and you're not going to have any dine-in. How are you going to handle that loss of income? And do you want to maintain your staff, especially in a full employment market? So you want to keep paying your staff even though you can't have them come to work because you're doing the reimage. You want to make sure that you have enough capital to do that. That is financeable if you do it the right way. So you want to make sure that you holistically look at what you need to get done and how long you need to get done it.
So now that we're at year end, we've discussed different strategies, et cetera, on how to grow, but now is the time to start preparing your financial records, et cetera, to get aligned or to get prepared for early 2019 growth. And so what every lender out there, we've talked about this, what every lender out there is looking for is cash flow based lending. So in other words, they're going to look at your cash flow and can you make the payments based on your cash flow? And so they have to verify that cash flow by clean financial records. So if you're new to franchising or just opened a unit this year, make sure that you're preparing financial statements that are clean. There's not a lot of personal expenses being buried in them, and let the business stand on itself. So that way the lenders can assess how well you're performing on the operation. Also, if you're looking to borrow money, especially if you've added units quickly in a shorter period of time, your time in business is less than 3 years, it's a good idea to tell your CPA that I want to add 1 or 2 or 3 or 4, however many units it would be in 2019, and get on their radar early and provide them with the information that they need to do 2 things. Number 1 is prepare your year-end financial statements, and also it's best to file your tax returns as quickly as possible. Ultimately, if you have added 2 or 3 units within a year and a half, there's a possibility that only 1 unit is reflected on a tax return. And so by getting your tax returns done early, then it starts to show reported results on your tax returns where they're not just relying on your internal financial statements to assess the ability to lend to you. I know a lot of people file extensions. If you're growing quickly, I urge you to get your tax returns done as soon as possible. And I already touched on the third bullet point here, but I'll reiterate it. Keep business business and run your personal life personal. Don't intertwine the two. Don't treat the business checking account like it's your personal checking account.
So what should a partner do for you in the capital markets? I think you've kind of gotten the hint along the way. When you're looking to borrow money, you want to go to someone who understands your brand, specializes in your industry, and in franchising itself. You want to have somebody that has various options so that it's not a single product that they're trying to fit a square peg into a round hole. And lastly, someone who's going to focus on your long-term goals and ensure that you have the capital available when you need it. So you want to get an advisor, whether it's Apple. We want it to be ApplePie Capital. That's why we're doing this. And that's really what we do. We help people succeed in executing business plans by providing financial vehicles for them to access during their growth period. You want to make sure you have somebody who understands that. Don't try to do it yourself. Don't ask your CPA because they don't know how to do it. Your lawyer doesn't know how to do it unless they do this every day. And that's something that we do every day here at ApplePie.
Hey, Ron, I got booted out of the webinar, so
Okay.
I'm going to wing this. Unless you want to just continue to go.
I'll just go because we're running short on time anyway. So what's the best way to lever your team, our team? You just need to talk to one of our loan officers. Our loan officers understand our assigned brands, so they understand the brands with whom they work. We give you access to our entire network, whether it's our core capital that is captive or our bank network. And we work very diligently to make sure that you get what you need when you need it. So that is the power that ApplePie brings to the to your business plan that you couldn't otherwise get by going to one bank that does SBA lending or one bank that does conventional lending. One of the cool tools that we have is a borrowing power tool. We keep talking about our core product and the 6-month look back. You'll see at the end a URL for you to go to at applepiecapital.com/grow, and you can calculate what your borrowing power is in your existing business just by going and filling out a few fields, and we can then help you execute on what you want to get done for the balance of your growth period. And that's what we've got for today. We've been able to do it with 4 minutes left for Q&A. I think we're current on the questions. I see the office just did put a hyperlink into the calculator. If anybody wants to go on that calculator, that would be great. You can go just click on it right now. And if there's no other questions, I think we'll wrap it up and give you 3.5 minutes back in your life. So thank you all for attending, and we look forward to working with all of you. Have a great day.
Yeah, thank you.